So FHA versus conventional loan. There's a lot of misinformation as to why your loan officer might recommend one versus another. So let's go through it. There is nothing wrong with any loan type in any way, shape, or form. It becomes a question of which one is going to benefit you, the buyer, the best and accomplish your goals in a way that fits your puzzle pieces. So let's start off with conventional can be as low as 3% down. FHA is 3.5% down at the minimum. Those two things are the way that they are. Now, that 3% down, you have to be under 80% of the area median income, or if your loan officer actually has access to the Home One program, you just have to be a first-time home buyer. So that's number one. Otherwise, you have to put down at least 5%. Number two, if you have a lot of debt, in order for you to have the maximum buying power, it might be better for you to go on an FHA loan because conventional loans cap you at a 50% debt to income ratio, whereas FHA loans cap you at a 56.99%. Now, most loan officers are not going to take you all the way to that top, but it gives us more flexibility in order for you to purchase the home that you want to purchase. And again, we're talking about your complete debt to income ratio, not just your housing expense. The other big thing is monthly payment. And what a lot of people don't realize is that number one, FHA loans have a lower interest rate. They have a lower interest rate than a conventional loan. But besides that, they have a lower PMI than your conventional loan, even when you're a first-time home buyer. Lower interest rate, lower PMI means lower payments. So since everything that we do these days is payment driven, it makes a difference how everything comes together for the puzzle pieces. And just to bring it home, I figured I'd show comparisons of an FHA, a conventional, if you're not able to do a one of the affordable loan types, which means that you're under 80% of the area median income, and a conventional loan utilizing Home Ready or Home Possible, just for you to look. And I kept them all at 5% down and the exact same thing. The other thing that comes into play is to be in a conventional loan, you have to have at least 3 months worth of reserves. That means 3 months of the mortgage payment sitting somewhere that you can access if something were to happen. FHA doesn't require this. This is a quote that I did. And again, this is me. We're looking at a 640 FICO score, and this a bit bigger because I can. We're looking at a single family home. I just happen to do the address in Virginia, primary residence, single unit, just a run of the mill, nothing fantastic, nothing horrible, nothing anything. Now, for all of these, I did 3 months worth of reserves just so that everything was equal all the way through. Again, FHA, you can put down as little as 3.5%. On a conventional, you can put down as little as 3%, but I did 5%, so I had the same thing across the board. Because again, if you're not able to do a Home Ready, Home Possible, or a Home One loan, you're going to have to put down at least 5%. So that made the most amount of sense for this comparison. We're looking at this one's conventional. This one's also conventional, and here's your FHA. Now, if you look, they're all $350,000 homes. They're all 95% loan to value. All of that's the same. The property taxes, 255, 150, 255, 150, 255, 150. So the only thing that's changing on these three things is going to be your interest rate and your mortgage insurance. Now, some people call it PMI, some people call it MI, it doesn't matter. It's the mortgage insurance that has to get paid per month for now putting down at least 20%. Okay, so on your conventional loan, you've got a $28.58 monthly payment with a PMI of 269. This is one of the affordable ones. On this conventional, you've got a payment of 31.27. This has a PMI of 369. Which one would you rather pay between the two? Everybody's going to say the lower monthly payment. But again, it's a question of if you qualify for that affordable loan. Now, your interest rate on this one is a 6.875. The interest rate on a standard conventional, you're looking at a 7.625. And again, this is only at a 640 FICO score. Now, if you come over here to the FHA, which has the lowest monthly payment, your PMI is $138 per month. That's almost half of what it is on the conventional. The interest rate here is a 6.75, which is similar to the one over here on the affordable, but it's definitely lower by almost an entire percentage point than the standard conventional. So this is how all of these things come into play. And just so that we're in clear unison, we're looking at this one, you have to pay $549 in order to get to this interest rate. To get to this interest rate, you're looking at $2,849 because at a 640 FICO score, I couldn't get any lower points in order to try to make the interest rate look a little bit more comparable to the rest of them. And on this one, you're actually getting $34 worth of lender credit. And again, these are considered par rates because there's almost never a zero cost or a zero credit for an interest rate. So this was as close to par as I can get with these three with the exact same scenario all the way through. Same 30-day lock period. None of them have a prepayment penalty. The lender fees are pretty similar in between. So that's your underwriting fee. And your other closing costs are going to be a little bit higher on the FHA because of the upfront insurance. But look at your cash to close difference. $35,645, $38,028, and $35,057. So not only is your monthly payment lower on the FHA loan, but so is your cash to close requirement. Even though, again, we're looking at, when we're talking about cash to close, that is going to be your prepaids, that is going to be your new escrow account, that's going to be all your title fees, that's going to be all your loan costs and your down payment. That's everything that's the estimated cash to close. Now, on top of that, for both your conventional loans, if you have an agent who can and is willing to negotiate for seller concessions on both of your conventional loans, because you're not putting down over 10%, you can only get up to 3% in seller concessions to cover those closing costs. On the FHA, you can get up to 6%. So it gives you more ways to go to bring less cash to closing. Not to mention the fact that a majority of your down payment assistance programs, they do require you to have an FHA, a VA, or a USDA loan. They want that government-backed loan because it makes it more secure for them. But as far as PMI is concerned, PMI is not a bad thing to have. And most people refinance their loan within 5 to 7 years for numerous reasons, whether it be to lower the interest rate, whether it be to pull cash out, any number of reasons why people refinance their loans within 5 to 7 years on average. Do also know too, one of the other benefits of being in an FHA loan is you can streamline down to the lower interest rates when interest rates drop. What's the difference between a streamline and a refi? Very simply put is I care that you have a job, but I don't care about your debt to income ratio. We don't need to do an appraisal and it's 15 days and you're in your new interest rate. Versus when we're doing a full refi on the conventional, you have to get the appraisal. I care about your debt to income ratio. All of that stuff comes back into play. It's basically a full loan process all over again. So these are some pros and cons between the two different loan types. And if you have an agent who has an issue with different loan types, please find another agent. One of the big issues is that some agents are trying to talk people out of certain loan types that could benefit them. Now, understand too, today is March 28th. These rates were before the rate sheet came out today. And it's only good for basically yesterday's dates. But this just gives you an idea as to why somebody might go FHA versus going conventional. It's not about the amount of money down. As a matter of fact, it's more important how much money you have in reserves for any loan type. That gives you more chances of getting an appraisal waiver. That makes your file look stronger. That is the bigger determining factor as to whether or not your loan is a good loan. It's not even your credit score. Whether you're somebody who's looking to purchase a home within the next 6 to 12 months or right around the corner, or you're a real estate agent. If you are not in my states, I will give you the basic overall information. If you are in my states, I'll be more than happy to give you detailed information. And for all agents out there, we do hold a class on Wednesdays from my corporate office to help you understand some of the loan types that are out there. And you can ask questions live. It's a live call. It's 20 to 30 minutes every Wednesday for things you might not actually know. Hope this helps to kind of clarify the difference between a conventional loan versus an FHA loan.